For as long as complex societies have existed, they have followed a familiar arc: expansion fueled by innovation, prosperity amplified by leverage, confidence hardened into certainty. Then, quietly at first, the mechanisms that once created growth begin to produce fragility instead. The pattern is not dramatic when it starts. It rarely announces itself. It advances through spreadsheets, incentives, and balance sheets long before it ever reaches streets or headlines. At the center of every systemic collapse is the same quiet exchange. Future stability is traded for present comfort. Obligations are extended forward, productivity is assumed rather than earned, and risk is diluted until no one can see where it truly resides. Wealth continues to circulate, but increasingly it does not accumulate. It passes through institutions faster than it can anchor itself in real output. The system grows larger, but thinner. This is not a failure of leadership or morality. It is a failure of structure. When systems scale beyond the discipline that built them, they must rely on confidence to replace constraint. Confidence becomes policy. Narrative becomes protection. Over time, the system stops rewarding creation and begins rewarding positioning. Those closest to the flow of money prosper. Those furthest from it feel stability slipping, but cannot explain why. History shows that collapse rarely arrives as a single event. It unfolds as a long period of normalization. Debt becomes permanent. Emergency measures become routine. Productivity slows, but consumption does not. The gap is filled with credit, leverage, and increasingly abstract promises. Each cycle requires more intervention to achieve the same effect. Each intervention reduces the system's ability to self-correct. What makes this pattern especially dangerous is how survivable it feels while it is forming. Markets adapt, institutions endure, metrics are adjusted, success is redefined. By the time instability becomes visible, it has already been absorbed into the architecture. The system has trained itself to depend on the very forces that weaken it. This cycle has played out across empires, monetary regimes, and financial systems for centuries. The names change, the instruments evolve, the technologies improve, but the incentives remain remarkably consistent. When growth is borrowed rather than generated, time becomes the enemy. When stability is managed rather than earned, resilience disappears. Those living inside the pattern rarely recognize it for what it is. They experience it as progress, modernization, sophistication. They are told that past constraints no longer apply, that new tools have solved old problems, that history has been outgrown. It never has. Every system that reaches this stage believes it has found a way to extend the cycle indefinitely. Every system is eventually proven wrong. And by the time the realization arrives, the outcome is no longer a choice. Large-scale collapse does not look like chaos at the beginning. It looks like continuity. Institutions remain open. Markets still function. Laws are enforced. Daily life continues with only minor adjustments. The defining feature of systemic failure is not sudden breakdown, but gradual distortion. The system continues to operate, but it no longer behaves as designed. Collapse begins economically because economics governs incentives. When incentives shift, behavior follows. Political and military crises are downstream effects, not causes. Long before trust is lost in leadership or security, it is lost in value. Currency, labor, capital, and time begin to disconnect from one another. Effort produces less return. Risk produces less reward. Stability becomes conditional. In the early phase, growth appears strong, but it is increasingly artificial. Credit expands faster than output. Asset prices rise faster than wages. Financial activity grows faster than productive capacity. This creates the illusion of prosperity while hollowing out the base that supports it. The system becomes dependent on expansion simply to remain upright. As the cycle progresses, distortion becomes normalized. What once required justification becomes standard practice. Temporary measures are extended indefinitely. Debt is no longer a tool, it is the foundation. The system moves from growth to maintenance. Resources are increasingly allocated to preserving existing structures rather than building new ones. Innovation slows, not because creativity disappears, but because incentives no longer reward it. By the time decline becomes visible, the system has entered a critical transition. Productivity stalls. Complexity increases. Bureaucracy multiplies. Risk is redistributed rather than reduced. Losses are socialized, while gains remain concentrated. This is the phase where confidence becomes essential. Without belief, the structure cannot hold. Historically, collapse unfolds in stages. First comes expansion driven by genuine productivity and innovation. Second is leverage, where future output is pulled forward to accelerate growth. Third is financialization, as capital seeks returns in speculation rather than production. Fourth is distortion, where prices, signals, and risks no longer reflect reality. Fifth is dependency, when the system cannot function without constant intervention. Sixth is loss of confidence, when participants quietly begin to exit or disengage. The final stage is consolidation, where power and resources concentrate rapidly as the system contracts. These stages do not move at a fixed pace. They overlap, reverse briefly, and often appear manageable. What makes them dangerous is their irreversibility. Each stage reduces optionality. Each intervention limits future responses. By the time the final phase begins, the outcome is already embedded. Collapse is not the end of activity. It is the end of coherence. The system still moves, but it no longer serves the purpose it was built for. And once coherence is lost, restoration becomes exponentially more difficult. The Roman Empire offers one of the clearest illustrations of this process, not because it fell suddenly, but because it endured long after its foundations had weakened. Rome's rise was built on discipline, productivity, and a tightly organized system of incentives. Military expansion secured trade routes, law standardized commerce, coinage created trust across vast distances. For centuries, Rome converted conquest into surplus and surplus into stability. But expansion carried a hidden cost. As borders stretched, maintenance replaced growth. Legions once used to acquire resources were increasingly deployed to defend what already existed. Administrative complexity grew. Taxes rose. The system required more input just to sustain the same output. Productivity in the core slowed, while consumption at the center continued to rise. To bridge the gap, Rome turned to monetary manipulation. Silver content in the denarius was gradually reduced. Officially, the coin retained its face value. In reality, it represented less work, less metal, less trust. This allowed the state to meet obligations without addressing structural imbalances. It also distorted prices and wages across the empire. Soldiers were paid in currency that bought less each year. Merchants raised prices not out of greed, but survival. Debt accumulated, though it was rarely labeled as such. Future tax revenue was pledged to fund present expenses. Wealth flowed into Rome from the provinces, but it did not circulate back into productive investment. Infrastructure decayed outside the capital. Local economies weakened. The empire became increasingly extractive, relying on control rather than creation. As productivity declined, social cohesion followed. Small landholders were pushed out by large estates. Labor shifted from free citizens to coerced systems that prioritized stability over innovation. Economic mobility narrowed. Loyalty was purchased rather than earned. The system still functioned, but it no longer adapted. By the 3rd century, Rome was managing crisis rather than pursuing growth. Emergency measures became permanent. Authority centralized. Control replaced flexibility. The empire survived for centuries after this transition, but it never recovered its earlier dynamism. Wealth continued to move through the system, but it failed to remain within it. Each cycle of intervention weakened the next. The fall of Rome was not a single moment. It was the cumulative result of decisions that prioritized continuity over correction. By the time external pressures intensified, the internal structure was already brittle. Rome did not collapse because it was attacked. It collapsed because it could no longer sustain itself on its own terms. Centuries later, a remarkably similar conviction emerged in a very different setting. In the early 20th century, the global financial system was anchored by industrial expansion, international trade, and a belief in permanent modernization. The world had railroads, telegraphs, centralized banking, and unprecedented coordination between governments and markets. Many believed these advances had rendered old cycles obsolete. The period leading up to the Great Depression was defined by confidence. Productivity had surged. Capital flowed freely across borders. Credit expanded rapidly, not just to businesses, but to households. Financial innovation allowed risk to be sliced, repackaged, and dispersed. This dispersion was interpreted as stability. The system appeared sophisticated enough to absorb shocks without consequence. But the same pattern quietly reasserted itself. Growth increasingly relied on leverage rather than output. Asset prices rose faster than incomes. Consumption was sustained by borrowing against expected future prosperity. The belief that this time is different was not rhetorical. It was structural. New tools, new institutions, and new theories were assumed to have solved the problem of cycles themselves. As in earlier systems, distortion came before collapse. Signals that once guided decision-making became unreliable. Stock prices no longer reflected productive value. Credit ratings assumed perpetual expansion. Risk models were calibrated to recent calm rather than historical volatility. Losses were considered improbable because they had not occurred recently. When pressure finally appeared, it was initially dismissed. Markets corrected, then rebounded. Authorities intervened selectively. Each response reinforced the belief that control was possible. But these actions addressed symptoms, not incentives. The system had become dependent on continued expansion to remain solvent. When expansion slowed, obligations remained. The contraction that followed was swift, but its causes were decades in the making. Debt that could not be serviced triggered asset liquidation. Falling prices increased real burdens. Confidence evaporated, not because people panicked irrationally, but because the numbers no longer worked. What had seemed like temporary illiquidity revealed itself as structural insolvency. The most revealing aspect of this period was not the crash itself, but the disbelief surrounding it. Even as indicators deteriorated, the prevailing assumption was that recovery was imminent. The system had worked too well, for too long, to fail completely. That assumption delayed adjustment and deepened the eventual damage. The outcome followed the established pattern. Consolidation accelerated, power centralized, emergency measures reshaped the system permanently. The world moved forward, but on altered terms. Once again, the cycle had not been broken. It had merely repeated under new conditions, with greater complexity and higher stakes. The modern system operates on a scale unmatched by any prior era, but it is governed by the same underlying mechanics. Global output, trade, and finance are tightly interwoven. Capital moves instantly. Obligations are layered across institutions, nations, and generations. This interconnectedness is often described as strength. Structurally, it is also exposure. Over the past several decades, growth has become increasingly dependent on monetary expansion rather than productivity gains. Debt has grown faster than the real economy across households, corporations, and sovereigns. This is not the result of irresponsibility and isolation, but of incentives that reward short-term stability over long-term resilience. When lowering the cost of capital becomes the primary tool for maintaining growth, leverage ceases to be exceptional and becomes normal. Productivity, meanwhile, has struggled to keep pace. Technological advances have improved efficiency, but their gains have been unevenly distributed and often absorbed by financial structures rather than reinvested into broad-based capacity. Asset values have risen dramatically, while the underlying cash flows that support them have grown more slowly. The system compensates by extending duration, increasing complexity, and assuming continued confidence. Monetary intervention has played a central role in preserving coherence. Each period of stress has been met with greater liquidity, broader guarantees, and more aggressive stabilization. These actions have been effective in the narrow sense. They have prevented immediate collapse, but they have also altered behavior. Risk-taking has been reinforced. Loss sensitivity has declined. Market signals have softened. What emerges is a system that appears stable precisely because instability is absorbed early and quietly. Volatility is suppressed. Failures are deferred. The cost is not visible in the moment. It accumulates in the background as reduced flexibility. When every downturn requires extraordinary measures, those measures become prerequisites rather than exceptions. This is where historical parallels become most relevant. Systems fail not when they stop functioning, but when they stop self-correcting. When incentives no longer reward prudence. When success depends, less late-stage systems are defined by an unsettling paradox. They feel most stable just before they become most fragile. Volatility declines, not because risk has been eliminated, but because it has been absorbed, deferred, and redistributed. Institutions grow larger. Backstops expand. The visible surface calms, even as pressure builds beneath it. In this phase, warning signals do not disappear. They are reinterpreted. Rising leverage is framed as efficiency. Asset inflation is described as wealth creation. Declining participation is explained as transition. Language evolves to accommodate imbalance. New metrics are introduced to validate outcomes that older measures would have questioned. Stability becomes a narrative as much as a condition. Institutional behavior adjusts accordingly. Decision-makers are not blind to risk. They are constrained by incentives. Acting early carries immediate costs and uncertain benefits. Acting late offers short-term relief and shared responsibility. Delay becomes rational. Intervention becomes expected. Each cycle reinforces the belief that consequences can be managed incrementally. Risk, meanwhile, becomes normalized. What once would have been considered extraordinary is treated as baseline. Balance sheets expand, time horizons extend, dependencies deepen. The system grows less tolerant of disruption, even as disruption becomes more likely. Resilience gives way to optimization. Public confidence persists longer than expected because daily function remains intact. Employment continues, payments clear, markets open. The absence of immediate failure is interpreted as proof of durability. Those who raise concerns are dismissed not because they are incorrect, but because their timelines do not align with institutional priorities. History shows that this is the most dangerous moment, not because collapse is imminent, but because optionality has narrowed. The tools available to address the next disruption are already in use. The buffers meant for emergencies are fully deployed. When the system requires constant support to remain stable, stability itself becomes conditional. Acceleration does not announce itself with a single event. It emerges when responses lose effectiveness, when each intervention must be larger than the last to achieve the same result, when confidence shifts from being assumed to being actively maintained. At that point, momentum replaces control. What follows is not chaos, but compression. Adjustments that could have occurred gradually are forced to happen quickly. Structures that depended on continuity discover how little margin remains. The system moves, not by choice, but by necessity. And once acceleration begins, it rarely pauses long enough for reconsideration and contribution and more on proximity to capital flows. Confidence becomes the final asset. As long as it holds, the structure remains intact. When it weakens, adjustment accelerates. The modern system has not reached a conclusion. It is still operating. But like those before it is increasingly shaped by the need to maintain continuity rather than generate renewal. History suggests that this distinction matters far more than optimism or intention. History does not repeat because people fail to learn. It repeats because the conditions that shape behavior remain remarkably consistent. Incentives outlast individuals. Structures persist across generations. Each system inherits not only the achievements of the past, but its unresolved imbalances. Over time, those imbalances assert themselves. What ultimately determines the fate of complex systems is not intelligence or intent, but alignment. When rewards are linked to long-term contribution, systems regenerate. When rewards are linked to short-term extraction, systems endure briefly, then weaken. This shift is rarely malicious. It emerges gradually as scale increases and distance grows between decision and consequence. Human behavior adapts to the environment it operates within. If leverage is cheap, it will be used. If risk is absorbed elsewhere, it will be taken. If stability is maintained externally, internal discipline erodes. These responses are rational. They are also cumulative. What feels manageable at one stage becomes constraining at the next. Cycles persist because correction is uncomfortable while distortion is survivable. Adjustment requires accepting loss, slowing consumption, and redefining success. Continuity requires only confidence. For long periods, confidence is enough. Eventually, it is not. At that point, outcomes are shaped less by choice than by arithmetic. The lesson of history is not that collapse is inevitable in a dramatic sense, but that consequence is unavoidable when incentives remain misaligned. Systems do not fail all at once. They adapt until adaptation itself becomes the risk. By the time clarity arrives, the range of possible futures has narrowed. Understanding this pattern does not grant control over it. Awareness does not eliminate cycles. What it offers instead is context, a way to interpret signals without panic, a framework for recognizing when stability is being maintained rather than earned. History does not provide timelines. It provides tendencies. Every era believes it is exceptional. Every era is correct in its details and mistaken in its conclusions. Complexity increases, tools improve, scale expands. The underlying dynamics endure. When systems prioritize continuity over coherence, they trade resilience for time. Eventually, time runs out. If you're watching for the first time, welcome to the Economy Club. This is where we study the forces that shape history and the patterns that quietly decide the future. Stay curious, stay grounded, and we'll see you in the next cycle.